Welcome to the Alliance Group's 12 Keys to Financial Certainty presentation. The Alliance Group is a growing organization of like-minded individuals and professionals who are deeply concerned about the financial direction our country is heading and the impact it will have on our financial future. Our mission is to create financially empowered individuals and families. Financially empowered families enjoy the highest degree of financial certainty because they reduce risk to the lowest level possible, and they have utilized every available dollar at its highest and best use to create the maximum benefits for their use and enjoyment. Financially empowered families have learned how to use each and every dollar to create the maximum benefits for themselves. They understand how to make $1 do more than one job, thus also creating multiple benefits. They understand how to reduce the wealth transfers in their lives so they can retain and keep more of what they earn. Because new financial paradigms have been created by the global economy, demographics, and the internet, it is more important than ever that we understand how money really works. The economic future we are living into is far different than anything we have experienced in the past. We are in a new financial paradigm, a new financial model that requires an entirely new way of thinking. We teach people financial truths, educating people about how money really works, and help them understand there are many things that they think to be true about money that are not. We teach them how to reduce financial risks and how to identify the wealth transfers in their life and reduce them. We teach them how to transform debt into wealth and implement financial strategies that create greater financial certainty so people can have a more predictable and secure financial future. Why are we teaching this? The average American will earn well over $2 million during their working lifetime. Yet, when it comes time to retire, studies show they will have less than $60,000 saved. By identifying the wealth transfers in our lives, we can implement financial strategies to reduce them. By reducing the wealth transfers in our lives, we will keep much more of what we earn and ultimately end up with far more money to use during our lifetime and to retire on. For this reason, we have created what we refer to as the 12 Keys to Financial Certainty. The first key is to become educated about how money really works. If we want to take control of our financial lives, then we need to spend some time and effort to learn the truth about how money really works and then apply what we've learned to our own lives. Key 2 is to understand that many of the things you think to be true about money are not. The question you need to ask yourself is, if something you thought to be true wasn't, when would you want to know about it? For most of us, the answer to the question is immediately. As an example of this, let's consider for a moment how returns in the stock market work. Since the early 80s, we have been encouraged to save for retirement through 401ks, which typically use mutual funds comprised of stocks from the stock market. To demonstrate this, we're going to use an exaggerated example of how returns might be applied to a lump sum in a retirement account. Let's look at an account with $100,000. Let's assume for a moment that there is no possible chance for loss of principal and the mutual fund manager is guaranteeing a 25% average rate of return. If this were truly available, it would be a great investment for our retirement. So let's apply some market returns and see what happens. Let's pretend for a moment that in the first year, our account experiences a year of growth like what happened in 1999. During that year, there were a number of mutual funds that actually returned over 100%. So in our example, you started with $100,000 and now you have $200,000 in your account. You would certainly be very excited and happy with the results. Let's go to the next year. Unfortunately, in the second year, your account experiences more of a 2008 type of year and incurs a 50% loss. Now, you're not as happy as you were before. 2 years earlier, you started with $100,000. Then it rose to $200,000 in value, and now it's back to $100,000. But wait, you have a guarantee from your mutual fund manager of a 25% average rate of return. So with that guarantee in hand, you approach him to receive what you expect to be a check for over $150,000. Unfortunately, though, you did not read the fine print in your agreement, which stated that you were guaranteed a 25% average rate of return, not effective yield. By applying the math, 100% positive return minus a 50% negative return equals a 50% positive return. Divided by 2 years equals a 25% average yearly rate of return. But the effective yield is actually zero. The vast majority of mutual fund returns are recorded as average returns, not effective yields. What that means is that the average rate of return means absolutely nothing. The most important number for you to consider is the effective yield on your money. This is just one example of something that we thought to be true about money that is not, and there are many more. Key 3 is to understand that the financial environment is constantly changing and that you must learn to adapt your financial plans. If we continue to do what we have always done, we may get the results we've always expected. But in our constantly changing financial environment, you may not get the results you were hoping for. We need financial strategies that will produce the intended outcome and create financial certainty. If in early September of 2001, we told you that in the next 10 years that terrorists were going to fly planes into the World Trade Center, we would go to war, we would experience a significant recession, and millions of Americans would have to file for bankruptcy and lose their homes, that our healthcare system was going to be socialized, and that Martha Stewart would go to prison, you would have thought we were nuts. The point is that things are going to constantly change around us, and we have to plan for that change instead of reacting to it if we want to be able to survive and thrive financially. Taxes are just one example of how things constantly change. When asked what the highest marginal tax bracket in this country has ever been, most people have no idea. The highest marginal tax bracket we ever had in this country is 94%. Now, that doesn't mean that if you made $100,000 that you had to pay $94,000 in taxes. What it means is that some portion of your income above a specific level would be taxed at 94%. As you can see from this graph, income taxes have gone up and down many times depending on what the economy was doing and how much money the government needed. In 1917, the government significantly increased taxes to fund our military needs for World War I. In the early 30s and 40s, the government raised taxes again because of the Great Depression and World War II. One thing we can count on is that when the government needs money, it will increase taxes. In the early 80s and early 90s, tax brackets were substantially reduced from previous levels. But what most people don't remember is that in order to drop tax brackets but still receive its desired revenue, the government needed to eliminate some tax deductions. Prior to those tax law changes, you could deduct the interest you paid on your car and truck loans, even the interest on your credit cards. The elimination of those deductions ended up directly affecting the middle class by actually increasing their tax burden. Given the current market and economic conditions in this country, where do you think taxes are going? If you believe that your taxes in the future are going to be higher and that you might have fewer deductions to offset those taxes, doesn't it make sense that you begin planning today to implement financial strategies that could substantially reduce your future taxes or in some cases eliminate them entirely? Key 4 is to identify the wealth transfers in your life and then take the steps necessary to reduce or eliminate them. Wealth transfers are without a doubt one of the biggest obstacles we face as we attempt to save money and build wealth for our future. Understanding what wealth transfers are and what you can do to avoid them or reduce their impact on your financial life is extremely important. A wealth transfer could be defined as any financial transaction in which money leaves any of your financial accounts never to return. Once you understand what a wealth transfer is, you'll be able to identify them and begin to strategically reduce or eliminate their negative financial impact in your life. Wealth transfers are all around us. Here are just a few quick examples. Credit card payments. Every payment that leaves your checking account to pay on a credit card will never return and will never accumulate or earn interest for your benefit. Taxes are another wealth transfer. State and federal income taxes are wealth transfers. Sales taxes are wealth transfers. Gasoline taxes, property taxes, virtually all taxes are wealth transfers. While it's true that there are some taxes, such as Social Security, where you may ultimately get some of your money back, that is not the case with most taxes. Most insurance payments are wealth transfers. When you pay your insurance premiums, whether it be for car insurance, homeowners insurance, health insurance, or some types of life insurance, the only way you're going to see any of that money back is if something bad happens. Every premium dollar the insurance companies get to keep They get to reinvest for their benefit, not yours. These are just a few of the many wealth transfers we encounter nearly every day. We believe you can create greater wealth faster by controlling the wealth transfers in your life than you can by chasing rates of return and taking more risk. A car payment is a perfect example of a wealth transfer. Let's assume you have a $500 per month car payment for 48 months. Your total out-of-pocket expense over that 4-year period is $24,000. Because you no longer have that money, this is considered a wealth transfer. It's true, you may still have the car, but you no longer have the money. There is an additional cost to wealth transfers, though, and it is what's called a lost opportunity cost. The lost opportunity cost is the interest you could have earned on that car payment if you'd been able to save it rather than paying for the car. If you could have delayed or avoided the purchase of the car and saved the $500 per month and earned 5% interest on that savings, at the end of 4 years, you would have $26,618 in your account. So the initial lost opportunity cost in this example is the interest of $2,618 you could have earned, but you didn't because you bought a car instead. The lost opportunity cost actually doesn't stop there, though, because you can never earn interest on those car payments. But the bank you made those payments to gets to keep reloading your payments and earning interest on them forever. So wealth transfers and their lost opportunity costs are eternal. No one in your family ever gets them. Reducing wealth transfers and their lost opportunity cost plays a vital role in building wealth. Key 5 is to reduce your financial risk to the lowest level possible. We have been led to believe that when it comes to making more money or earning interest, some risk is acceptable. In fact, we've been taught that the risk is desirable if we want to get higher returns. The real financial truth is that you can create far more wealth by reducing the wealth transfers in your life than you can by taking unnecessary risks chasing higher returns. Here's an example of what we're talking about. Let's take a look at a typical middle-aged couple that in the eyes of most people, including themselves, is doing pretty good. They have an annual household income of $100,000. They have a retirement account with a balance of $150,000 they hope will return an average of 10% or $15,000 per year, although there is no way to predict what the future returns will be. The problem is that while you are saving for retirement and hoping for those high stock market returns, if they are a typical couple, they have annual after-tax consumer debt payments equal to 34.5% of their income leaving their checking account, never to return. This debt service includes credit cards, car payments, student loans, and mortgage payments, just to name a few of the standard wealth transfers. So while they might be receiving a $15,000 gain in their retirement account, they are actually experiencing a $34,500 wealth transfer from their checking account. Not only does this wipe out their $15,000 gain, what it really means is that they have a net wealth loss of $19,500 each year. Most people are only focused on the return they are getting on their savings and investments. But as you can see, while you're hoping for high returns on your investments, the wealth transfers in your life are transferring the rest of your hard-earned money away from you at a much faster rate than you are growing your investments. What we really need to focus on is minimizing our wealth transfers. Reducing risk and wealth transfers creates greater financial certainty. This is something that the wealthy in this country have known how to do for a long time. They even have 4 rules to follow. 1. Use the least amount of money to create the greatest amount of wealth. 2. Guarantee wealth will occur and the legacy will transfer tax-free. 3. Create multiples of wealth immediately using leverage and control of the asset. And finally, 4th, never risk the family's wealth. Warren Buffett even went so far as to state, should you find yourself in a chronically leaking boat, energy devoted to changing vessels is likely to be more productive than energy devoted to patching leaks. In other words, if what you are doing financially is not providing you with the results, safety, and certainty that you want, then it's time to make some changes. If you always do what you've always done, then you will always get what you've always got. We believe that by eliminating risk from your financial model and focusing on financial strategies that are not risk-based or market-based, and by reducing wealth transfers and recapturing the principal, interest, and lost opportunity costs of your debt, you will virtually guarantee a financial wealth building system that always produces the intended outcome. Key 6. How you save and invest your money is more important than where you save and invest your money. Let's take a look. In this example, we're going to assume that we're in a constant tax bracket of 25% and that we invest $10,000 in 3 different types of accounts. The first is taxed as it grows. The next is taxed at the end of its growth. And the last, we have already paid the taxes and never have to pay any tax on the growth, like in a Roth account. You can see that the amount of money that we get to keep and use in our retirement is dramatically different, even though our initial investment of $10,000 is growing at the same 7% for 28 years. The taxed as it grows account has $41,900. The taxed at the end account has $49,866. The tax-free account has $66,488, which is substantially more money than either of the 2 accounts. If you believe that taxes are going to be higher in the future, doesn't it make sense to strategically position your savings and retirement dollars in accounts that can be accessed free from income tax? When you stop and think about it, wouldn't you really rather pay taxes on the seed instead of on the harvest? How we save for our retirement today is one of the biggest changes that has taken place over the last 30 to 40 years. Beginning back in the late 70s and early 80s, we began to make a transition in this country as it relates to saving for our retirement. Up until that time, people saved for retirement. They literally put money in savings accounts to be used in the future when they retired. Beginning with the individual retirement account, or IRAs, in the 70s and later in the 80s with 401ks, future retirees continued to be encouraged to save for retirement. Only this time, it was suggested that they invest in the stock market through mutual funds purchased with their 401k money. 2 things changed during this time. First, the element of stock market volatility and risk was introduced into saving for retirement. We are beginning to see the damage that can do to retirement accounts. Second, people were told that it would be much better to grow their money tax deferred, as they would be in a lower tax bracket when they retired. Unfortunately, it looks as if we are headed to a future of higher tax brackets with fewer deductions. In a very short period of time, we went from saving for retirement to investing for retirement. We were told that the process was still safe. Even though there might be some risk involved, it would be very modest, and even if the market did drop, it would always come back. But what if it did not come back fast enough to make up for your losses before you wanted to retire? Do you have a financial backup strategy if that happened to you? We teach people how to avoid market volatility and market risk and implement financial strategies that create greater financial certainty. Key 7 is to understand that spending is emotional, so budgets generally don't work. Budgets don't work as they are just like a diet, which is negative. They tell you what you can't have. We as Americans are very emotional and impatient. We want things when we want them, and that can be a very bad habit. Here is an example. The woman in the house is out buying clothes for the kids to go back to school. While at the mall, she sees her favorite shoe store is having a 25% off sale, and she sees the perfect pair of shoes to go with one of her favorite outfits. Now, she doesn't really need the shoes, as she has plenty of pairs at home, but she wants the shoes, and she knows they'll look just great. And they're on sale, so she's saving money. Now, guys are just as bad as women. They buy sporting goods as they think that the new clubs or fishing rod will help them get better results. These are both examples of impulse buys or emotional spending. We teach our clients a unique financial strategy called the Family Banking Plan that converts your spending habits into wealth. Key 8. When you track your money, you control your money. We know that one of the biggest challenges our clients face is really understanding where their money goes. When you become a client of the Alliance Group and implement these keys to financial certainty, we will provide you with software to help you not only track your money, but also help you identify and reduce the wealth transfers in your life. Now, this is Tim and Laura. They're a 35-year-old couple that has $65,000 in annual after-tax household income. They want to retire at age 65, and they think that they'll need about $6,000 a month in income once they retire, but they have no real plan on how they're going to get there. They also want to control spending, get out of debt, reduce taxes, and manage savings. Their situation regarding wills, trusts, and financial planning is a mess, and they realize that they're underinsured when it comes to life insurance. As you can see, they do have some debts. They own a home with a $200,000 mortgage. They have 2 car payments, a visa, a school loan, but they're not out of control in their spending. But they do have close to $250,000 in debt on top of their normal living expenses. By using the tracking software, Tim and Laura can easily see how much money is coming in, how much is going out, and how much is left over for savings and discretionary income. We have found that most clients who complete this process will find between $250 and $350 per month to help them accelerate their debt elimination plan. By using this software to track our expenses, you can start to run your household the same way that a business runs. A business tracks its expenses each month to make sure that they are profitable throughout the year. Unfortunately, as individuals, most of us do not run our household the same way, which makes it very easy to get into financial trouble. Key 9 is a big one for many people as it deals with a topic that we often don't like to talk about, and that is debt. We have seen recently that our government doesn't like to deal with debt, and the debt spells out trouble, not only for our country, but also for us as individuals, as ultimately we are the ones that are responsible for repaying the debt. Key 9 states that consumer debt destroys wealth and so must be eliminated and replaced in the future with something we call the family banking plan. We can see here that we've detailed Tim and Laura's current debt. The key is to eliminate debt as quickly as possible so that we can start to concentrate on building wealth. By first eliminating the consumer debt, we've been able to save $5,966 in interest. The next step is to get the mortgage paid off, which saves us an additional $113,634 in interest. By using a debt elimination system that includes the family banking plan, we were able to accomplish this in 9.4 years. If you were able to start saving the $1,950 per month you were spending on consumer and mortgage debt for your retirement for the next 20 years, and you saved it in an account that paid only 5% per year, and you were able to keep the tax man away from it, you would have over $800,000 when retirement rolled around. The family banking plan is a unique financial strategy that builds wealth while eliminating debt. It teaches you how to recycle money, or how you can use dollars multiple times. It transforms debt, if you have any, into wealth. It reduces wealth transfers and their lost opportunity costs. It creates generational wealth in a tax-advantaged environment. And it's a way to transfer wealth to future generations income tax-free. By implementing the family banking plan, we have found that most families can be completely out of debt in 9 years or less. This even includes your mortgage, as we have just seen. Key 10 is understanding that money in motion creates more money. You need to think like a banker. Bankers apply a financial strategy or technique called velocity of money. We would like to keep this explanation simple, so for the time being we're going to avoid discussing the Federal Reserve and its role in our fractional banking system. Assume for a moment that you have $100,000 that you could deposit in a bank. And let's further assume the bank was going to pay you 3% interest. On the same day you deposit your money with the bank, they approved someone for a home loan at 6% interest. By loaning them your money at 6% and paying you 3%, the bank also made 3%, right? That 3% is actually what is called the interest rate spread. The bank actually made 100% return on the 3% they paid you. You earned $3,000 in interest, and they earned $3,000 in interest. But it gets even better, because the new homeowner gave the $100,000 the bank loaned them to the seller of the home, who put it back in the bank. Now the bank has the $100,000 to loan again, which they do to several people who want to buy cars. Those car buyers in turn give the money to the dealership, who returns the money to the bank. Are you seeing a pattern here? Someone comes in for a home equity loan to remodel their home. They give the money to the contractor who puts the money back in the bank. Some people come into the bank wanting to consolidate their debt, and so the bank loans them money to pay off their credit cards, and the credit card company puts the money back in the bank. As you can see here, the spread for each of those transactions is 3%, 4%, 5%, and 8%, for a total spread of 20%. If all those transactions happened every week, the bank would earn over 250% return on your money. The family banking system helps you think like a banker and use the velocity of money to your advantage. Next, let's talk about how the family banking system can transform debt into wealth. In this example, we want to talk about the old way to buy a car and the new way to buy a car. The old way to buy a car is to finance it. In our example, we're paying $30,000 for our car. We're borrowing money at 7% for 72 months or 6 years. That will give us a payment of $508.50 per month. Over that period of time, we will pay a total of $30,000 in principal and $6,612 in interest. We're going to assume that at the end of 6 years, we sell the car for $10,000. That means we end up with a net loss of $26,612 on that car. This is a wealth transfer, and remember, we never get that money back. By the way, you may be thinking that rather than financing the car, you would have paid cash for it. But there is a profound truth about money. You finance everything you buy. You either pay interest to someone to loan you the money, or you give up the opportunity to earn interest on the dollars you use to pay cash. You either pay interest or you give it up. Either way, there is a cost. So even if we just look at that $30,000, if you paid cash for the car, 6 years later when you sell it for $10,000, you're still out of pocket the $20,000 that you will never see again and you can never earn a single dollar of interest on in your lifetime. Let's look at the new way to buy a car, the family banking way. We're going to buy the same $30,000 car, only this time we're going to pay cash for it. Now, where do we get the cash to pay for it? By identifying and then reducing and eliminating the wealth transfers in your life. There is no magic here. It may take some time to accumulate enough money to buy this car, but once you've established the capital sum in your family banking system, you can apply this powerful strategy to your financial benefit for the rest of your life. Here's how it works. You pay cash for the car, but you amortize it at 7% interest, the same amount you would have been willing to pay the bank. That creates the same payment of $508.50 that you pay back to yourself every month for 72 months. You will pay the same $6,612 in interest, but instead of going to the bank, it goes into your banking system that you own and control. You will pay the same $36,612 over that 6-year period. Assuming you sell the car for the same $10,000, you would now have a total of $46,612 in your banking system. You started with $30,000, so your net capital gain is $16,612. So which would you rather have? A $26,612 loss in capital or a $16,612 gain in capital? The choice is yours. Key 11. Virtually every dollar can be strategically positioned to be recycled and do more than one job, creating multiple benefits. Let's take a look at how this could potentially work over a 4-year period of time. In the first year, we're going to assume that you have had the opportunity to capitalize your family bank and that there is currently a cash balance of $30,000 available. We're going to make a withdrawal of $30,000 to pay cash for a car, and then we're going to be a good banker and require ourselves to pay it back over 4 years at 6%. That creates a monthly payment of $701 per month that will allow us to deposit $8,412 back into our bank during the first year. So, $30,000 minus the $30,000 for the card leaves us a balance of $0. We're then going to add in the payments of $8,412, which will leave us a balance of $8,412 in our bank at the end of year 1. In year 2, we start out with a balance of $8,412, and now we want to buy an entertainment system. We withdraw $8,000 to purchase the entertainment system for cash, and again, like a good borrower, we make payments back to our bank at 10% interest for 3 years with a monthly payment of $256 or $3,072 per year. So a starting balance of $8,412 minus $8,000 for the entertainment system leaves us a balance of $412. We're then going to add our annual payments of $8,412 for the car and $3,072 for the entertainment system, giving us an ending balance of $11,896 at the end of year 2. In year 3, we start out with a balance of $11,896, and now we want to buy a boat. We withdraw $11,000 to purchase the boat for cash, and again, like a good borrower, we make payments back to our bank at 10% interest for 2 years with a monthly payment of $503 per month or $6,036 per year. So a starting balance of $11,896 minus $11,000 for the boat leaves us a balance of $896. We're then going to add our annual payments of $8,412 for the car, $3,072 for the entertainment system, and $6,036 for the boat, which leaves us an ending balance of $18,416 at the end of year 3. In year 4, we want to control our debt, so we decide not to purchase anything big this year. We start out with a balance of $18,416. We add back in our annual payments for the car, the home theater system, and the boat, which gives us an ending balance of $35,936 at the end of year 4. So financially, what really happened? You used the same $30,000 to finance $49,000 in purchases. You recovered $35,936 in principal and interest that would have normally been transferred away forever. Plus, you now own the car, the boat, and the home entertainment system. The real question is, where is the best place to store that money that you have for your family banking plan? There are a few places that you can store money safely. You could store it in a savings account. However, the interest rate might be quite low and it would be taxable. This is very inefficient and your money is only doing one job. We recommend you use a specially designed, specific type of insurance plan that emphasizes maximum cash buildup with the least amount of insurance. There are several advantages to utilizing these specially designed policies for your family banking system. First, you probably want and need some life insurance. Second, money stored in a life insurance policy grows tax-deferred and can be withdrawn tax-free. Third, you can earn a market rate of interest. Fourth, by using the cash values as your family banking capital, you reduce the wealth transfers in your life and keep the money for your use over and over. Fifth, when you are done using the cash value to finance things, you can use it for a tax-free retirement. And sixth, upon your death, you can leave the life insurance death benefit to your heirs, income tax-free. Let's just consider for a moment the fact that most people make car payments during most of their working life, and they also try to fund their retirement plan at the same time. What if you could use the same dollars to do both jobs? What if you could use your car payment to purchase your life insurance and provide for your retirement? What if every time you made a car payment, it came back to you in the form of future retirement dollars? How powerful would that financial strategy be? With the family banking plan, that's exactly what you can do. So very quickly, let's recap why we want to get rid of the local banker and start our own family banking plan. It means that there is no application, no credit checks, no loan denial, no waiting for funding, no banking hours. It's your money. There are disability benefits. You've got $1 doing multiple jobs. You have liquidity, use, control, certainty, and enjoyment. You also have the benefits of tax-deferred, tax-free, and tax-free transfer to heirs. Key 12 is that every financial strategy or product must create maximum liquidity, use, control, certainty, and enjoyment for every dollar during your lifetime, and then leave the maximum amount to your heirs. By using all 12 keys together and by employing the unique financial strategies we'll introduce you to, you will build wealth safely and predictably without market risk. You will reduce the wealth transfers in your life and transform your debt into wealth. You will keep more of what you earn, and every dollar you have will be doing multiple jobs, creating multiple benefits, and provide the maximum amount of enjoyment. Thank you for joining us for this presentation. We encourage you to get with the person that invited you to attend so that they can help you learn more about the 12 keys of creating financial certainty and how to implement the financial strategies that go along with them.